find some great assets to recapitalize, and why is nobody putting an effort into hitting some of these European companies and looking for opportunities?
I think it's come out that you can have different strategies for success, and our perspective, of course, is with our assets, with our resources, we're going to focus where we think we can be most effective. Bluntly, on Europe, we just think there's too much risk to be for our approach, for our resources, to be trying to take advantage of that. I also happen to think that it's going to take a while before it shakes out. I'd rather hear the thud of bottom before trying to anticipate when it's going to happen. I'd say also in Europe, aside from trying to understand markets, which is hard enough in and of itself, there seems to be lots of political input too, which is hard to assess when you're trying to make deals.
As we know, there just haven't been a lot of sellers in Europe yet at this point in time. Many of the over-leveraged assets and the loans that back them are controlled by banks or governments, and they have been definitely reluctant sellers, not interested in recognizing true mark-to-market kind of accounting, given the implicit losses that they'd like not to recognize. So it's been a pretty slow market from that standpoint. We have a long-standing presence there at TPG Capital and do have some real estate folks there. We closed a recapitalization of €1 billion real estate company in the Netherlands just a couple months ago, which we acquired at about a 65% discount to historic value. A very large 200-building portfolio, mostly in Rotterdam and Amsterdam. Admittedly, an unusual sort of transaction, but I think typical of the types of things we will do and others will do in Europe. This was a CMBS-backed company that had come to a final maturity date. It had to be resolved. It was an absolute catalyst for recapitalization, and by partnering with the A note holders, we were able to effect a restructuring that we thought was very attractive, but all based on price and creating current yield that we thought would deliver the vast majority of our return. As Bill has said, I think our corporate view at TPG of Europe remains extremely cautious. It's very hard to see a catalyst for renewed growth in many of the markets. And while, to John's question, we have spent time in Spain and elsewhere there, our view is you haven't heard the thud yet that Bill referred to. And without some visibility around a commitment on the part of the government and the population to take the bitter pills here and fix the underlying issues in their economy, same goes for France, same goes for Italy, it's just hard to see what the drivers of real GDP growth are in those countries in the foreseeable future. So in our view, the only way you can invest in markets of that character is by just buying so incredibly cheap that you're essentially getting your returns from cash flow and leases that you believe are going to stay in place. And that's not a hurdle we've been able to meet in Spain or Italy or France, although we're seeing some of those sorts of opportunities in Ireland, the UK, and as I said, the Netherlands.
Questions?